Hey everyone, welcome back to the channel. If you're new here, I'm Avi, a chartered accountant based in Melbourne, Australia. Today, we're going to dive into the basics of the stock market. Whether you have always wanted to invest but felt overwhelmed or you're completely new to the investing, don't worry, I'll break it down for you in the simplest way possible. In today's video, I'm going to share some surprising things about the stock market and teach you everything you need to know from what it is, how it works, and how you can begin your investing journey. And yes, in this video, I'm also going to reveal the top 6 investing strategies of Warren Buffett. Whether you are a complete beginner or just curious about getting started, this video is perfect for you. Remember that 13-year-old kid when his friends used to read the comic books, he was reading the balance sheets of the companies. The godfather of investing, Warren Buffett, who made his entire wealth through the stock market. Undoubtedly, he is one of the most successful investors in human history. His principles, strategies, and business ethics have inspired countless investors, from beginners to financial professionals. So today, I'm also going to give you some of his best strategies that will help you succeed in your investing journey. By the end of this video, you will understand the key concepts of the market, how to start investing, and why it can be a powerful way to grow your wealth over time. So let's get started. Alright, let's start with the most basic question. What is the stock market? The stock market is essentially a marketplace where people buy and sell stocks. Think of it like an online store, but instead of buying groceries or clothes, you are buying a small piece of ownership in a company. Shares basically represents a small ownership in a company. When you buy shares in a company, you are essentially buying a tiny portion of that company. This makes you a part owner or equity investor in that company. Let's take an example. Think of a company like Apple or Tesla. Let's say you buy 10 shares of Apple. This means that you own a tiny portion of Apple. And if Apple performs well, the value of your shares may rise. On the other hand, if they face challenges, the value of your share could fall. When you own shares, you can essentially earn returns in two main ways. Firstly, through price appreciation, which is through an increase in the value of your shares. So if the company's financial performance is strong and the demand for its share increases, your share price will go up. And secondly, through dividends. Companies pay a small portion of their earnings to shareholders as dividends. These are like regular payments to reward shareholders for investing. So the stock market essentially exists for companies to raise money by selling shares to the public. It facilitates the buying and selling of these shares. And the two biggest marketplaces for share in India are BSE and NSE, where you place orders and thousands of trades happen every single second. Now you might wonder, why would a company sell shares to the public? See, when a company needs capital to grow, innovate, pay debt, or expand into new market, it has several options to raise funds, primarily through angel investors or venture capitalists. But if the amount of capital required is too large, then the company can choose to go public by selling shares through an IPO. An IPO or initial public offering is basically when a company sells its shares for the first time to the public to raise funds. This allows the company to get money from public investors, and it also gives people like you and me a chance to invest in these growing companies. Investing in the stock market can undoubtedly have strong potential for growth and wealth accumulation over time, as the market provides a way to invest across industries as well as minimizing risk by diversifying an individual's portfolio. So now that we know what the stock market is, let's look at how it actually works. See, the stock market operates on the principles of supply and demand. Here's how it works. When demand increases or more people want to buy shares, the price of the share go up. On the other hand, when supply increases or more people want to sell shares, the price of the share go down. Now, the demand and supply of the shares are influenced by several factors like the company news, earning reports, economic conditions like inflation and unemployment, global events like political instability or wars. However, investor sentiment play a huge role in the market. Sometimes investors may overreact due to news, rumors, or global events, which can cause stock prices to fluctuate. The investor sentiment is also impacted by a lot of factors, which may include economic news like the unemployment rates, inflation, GDP growth, company earnings, quarterly reports, political events like elections or conflicts, and global crises like pandemic or natural disasters. When a company does well, say they release great quarterly earnings or launch a groundbreaking product, investors get excited. They want to buy shares and the demand for those shares rises. This pushes up the stock price. On the other hand, bad news like a product recall or a major financial setback can lead to a loss in investors' confidence. This leads to more selling, which lowers the demand and causes the stock price to drop. Imagine a tech company like Microsoft announces a new highly anticipated product. Investors' confidence soars because they expect strong profits. Many investors rush to buy shares of Microsoft, leading to higher demand and in turn higher stock prices. On the other hand, if that same company were to experience product delays or leadership changes, the opposite would happen. Alright, now that you got the basic idea of how the stock market works, let's discuss how you can get started in the stock market. The stock market might feel a little intimidating at first, but at its core, it's about spotting patterns, finding opportunities, and understanding risk. So how do you get started? Now there are two ways you can invest in the stock market. Either invest in mutual funds, which is indirectly, or buy shares of a company, which is directly. But today, before giving you one fundamental and powerful knowledge, I will share why people fail in the stock market. Look, first understand that only 4% of people in India invest in the stock market, while in America about 50% of people invest in the stock market. But why? Why do people in India not invest? First, people lack a risk appetite. Second, they have no knowledge. Third, there are no dedicated courses. And fourth, due to many scandals and frauds, people have suffered huge losses. While many people had suffered losses, some people made huge profits as well. You know about Warren Buffett, but in India there's an Indian Warren Buffett as well called Rakesh Jhunjhunwala. He also built his fortunes through the stock market. His early success came from a bold bet on Tata Tea in 1986 when he invested 5,000 rupees and the stock tripled in just 3 months, marking the start of his journey to becoming one of the India's wealthiest investors. That's how powerful the stock market can be. So I will give you a step-by-step roadmap so you can get started as quickly and as easily as possible. First things first, understand your goals. Why are you investing? Are you saving for long-term growth, retirement, or a down payment on a home? Your investment strategy will depend on your personal financial goals. Knowing your why gives your strategy direction and keeps you focused on the big picture. Next, know your risk appetite. Some people are okay with taking higher risk for the chance of better returns. Other people prefer steady growth. Understanding your own comfort with risk will help you choose the right investment and stick to your strategy. Thirdly, open your brokerage account. You will need this account to start investing. I personally use and recommend Zerodha because it's the largest discount broker in India and offers free equity delivery. It's an easy to use trading platform, making it a great choice, especially for beginners. If you are interested in joining Zerodha, I've added the sign up link in the description below. Fourth, don't put all your money into one company or one industry. Start with a small amount and diversify your investments across different sectors and asset classes. Why? Because putting all your eggs in one basket can lead to major losses if that company or industry faces a downturn or unexpected challenges. Spread your investments to stay safe and build stability. And fifth, thoroughly research your investments. Consider index funds or diversified ETFs to spread your risk effectively. They are simple, low-cost options that give you exposure to a broad market, reduces the risk tied to individual stocks. Also, stay updated on market trends and news. The market is always evolving and being informed will help you make smarter investment decisions. Keep it simple. Simple strategies are often the best choice for beginners. Finally, success in investing comes down to discipline and consistency. Regularly contributing even small amounts to your investments can work wonders over time because of compound interest. Stay consistent, stick to your strategy, and give your investments time to grow. Remember, patience pays off. Alright, now that you know how to start your investing journey, let's talk about some effective investing strategies for beginners. These strategies will help you approach the stock market with confidence. But before diving into the strategies, I want to talk about one of the important concepts in the stock market, the price to earning ratio. To understand that, we first need to know what Nifty 50 is. The Nifty 50 basically represents the top 50 biggest companies in India. Nifty reflects how the overall market is performing by tracking the performance of these large 50 companies. Essentially, you can gauge whether companies are generally doing well or struggling. Now, Nifty has its own price to earnings ratio. This shows how much money you invest and how much you can earn from these companies. So before investing in an individual stock like Reliance, TCS or Infosys, be sure to check the overall Nifty PE ratio. Why? Because it gives you insight into market trends over the last 30 to 50 years. The Nifty PE can range from a low of 10 to a high of 30. If it's low, it's a great time to invest as you will likely get better returns for less money. And if it's high, be cautious and invest very little. Whether it is the stock market or any other market, knowledge is essential. In business, basic knowledge is very important, but people want easy money and want to invest based on tips. Harshad Mehta's scam was just like that. At one point, ACC cement market price was 200 rupees, then he artificially created a buying spree and pushed its price all the way up to 9,000 rupees. But there was no strength in the company, its fundamentals were weak, its profitability was not growing, the top line wasn't growing, the bottom line wasn't growing, there was no compound annual growth rate. Despite all this, the share price skyrocketed purely through manipulation. This is what's known as artificially pumping and dumping, pushing the price up, then selling out and taking the exit. Those who exited at 9,000 made massive profits. A 1,000 investment at 9,000 represents a 9x increase, which was an instant overnight wealth for those lucky enough to exit. But this is risky and non-sustainable. This is what happens due to tips. So understand the basics and always check the price to earning ratio and the market trends with Nifty 50. When the PE is high, it's better to keep your money in safer options like FD, debt funds or cash. Remember, tips aren't the way to grow wealth in the stock market. Solid analysis and fundamentals are. Always check the numbers, understand PE and invest wisely. Now let's talk about the top 6 investing strategies of Warren Buffett. I guarantee these strategies will be extremely helpful and make a big impact on your investing journey. One of the most effective ways to grow your wealth in the stock market is through long-term investing. This approach focuses on underlying business, its competitive advantage, and its long-term prospects rather than short-term market fluctuations. Long-term investing is the idea of buying stock and holding them for years, even decades. Why? Because the market has historically trended upwards over the long term. Here's an example to make this clearer. Let's say invest $100 per month into S&P 500 for 30 years. With an average annual return of 10%, after 30 years you could have over $200,000. Compound growth means your initial investment and any profits or dividends you earn over time start earning returns themselves. Pick businesses, not stocks. Always take the time to thoroughly analyze and evaluate the business behind a stock. Focus on the fundamentals of companies you understand and are familiar with. Pay close attention to key metrics such as profitability, debt to equity ratio, return on equity, and intrinsic value to assess a company's overall performance. Companies with a sustainable competitive advantage, consistent earnings, strong brand loyalty, and effective management always tend to outperform those which don't. Try to avoid complex industries or companies you cannot understand. Diversification is another key concept that you must understand as a beginner. It's very simple. Diversification is spreading your investments across different industries, countries, and asset classes. This reduces risk because if one company or market sector performs poorly, your other investments can balance it out. Another best way to get started is through index funds. These are great for beginners because they are easy, low cost, and well diversified. An index fund is a type of mutual fund or an ETF that tracks a stock market index like the S&P 500 or Dow Jones Industrial Average. These indexes include companies from various industries and provide instant diversification. Next, let's talk about dollar cost averaging. This simple strategy involves investing a fixed amount of money at regular intervals regardless of market conditions. The great thing about DC is that it takes the pressure of trying to time the market, which can be stressful and tricky for beginners. Instead of worrying about whether the market is up or down, you are consistently investing over time, which can lower the risk of market timing mistakes and help you take advantage of market fluctuations. And finally, understanding risk is very important. Every investment carries some level of risk, but the idea is to manage that risk by allocating your money to various asset classes like stocks, bonds, and ETFs based on your goals, age, and risk tolerance. Always maintain a margin of safety in your investments. This means purchasing assets at a price significantly below their intrinsic value to provide a buffer against potential losses and unforeseen market fluctuations. Before we wrap up, let's quickly discuss some common mistakes that beginners should avoid when investing in the stock market. Many beginners think they can predict market trends, but the truth is timing the market is nearly impossible. The market fluctuates daily due to countless factors, and trying to perfectly time your entry or exit often leads to costly mistakes. Instead of chasing highs and lows, focus on consistency. Regular investments over time are far more effective for long-term success. Remember, it's not about timing the market, it's about time in the market. So stay consistent, stay patient, and let your investments grow. Fear and greed are two emotions that can ruin your portfolio. When markets dip, don't panic. And when there's a hype, don't let your greed drive you. Always invest based on your risk tolerance and long-term goals, not what everyone else is doing in the market. Just because others are jumping in doesn't mean you should too. So stay focused, stay rational, and make decisions that align with your plan, not your emotions. Don't put all your eggs in one basket. Diversification helps spread risk and keep your portfolio more stable during market downturns. Instead of putting all your money into a single stock or sector, invest across different industries and different asset classes. It's a simple way to protect your investments and improve your chances of long-term success. Always do your homework before investing. Research the company's financials, industry performance, recent news, and analyst rating before you buy. A little effort upfront can save you from costly mistakes later. Remember, informed decisions are the foundation of successful investing. Using high leverage can boost profits, but it can also amplify losses. If you are a beginner, it's best to avoid relying heavily on borrowed money for investments. Start small, stick to your budget, and focus on building a strong foundation first. Play it safe, grow steadily, and avoid unnecessary risks. Now let's quickly recap the key points we have learned in today's video. Firstly, understand your risk appetite, prioritize research, set your financial goals, and stay consistent. Secondly, avoid common mistakes like emotion-driven decisions, lack of diversification, and attempting to time the market. This can negatively affect your financial journey. And finally, focus on long-term investing. Start with index funds or dollar-cost averaging, which can help you get started without much stress. Always keep in mind to focus on the underlying business, its competitive advantage, and its long-term prospects rather than short-term market fluctuations. So there you have it, the basics of stock market for beginners. Remember, investing is a journey, not a race. Start small, stay consistent, and educate yourself every step of the way. If you found this video helpful, don't forget to hit the like button and subscribe to the channel for more entrepreneurial and financial tips. And of course, drop any questions you may have in the comment section below. Until next time, happy investing, and remember, if you are interested in joining Zerodha, the link is in the description below.